So we're going to talk about impact measurement and reporting, and maybe it's a good idea for us to start very broad. And while you called yourself the dinosaur in the room, which I think is not accurate at all, let us call you the expert, so to say. Why don't we have the expert talk first a little bit about the general criteria, the general regulation that exists, and sort of where you also see this heading?
Yeah, I mean, Tim already mentioned there is a huge problem with the semantic here. The ESG is, let's say sustainability is the overall term for all of this. And this means that we have a responsibility to let the planet in a way that the next generations will have the possibility of doing what they need to do and what to do. So that's our responsibility for them. Now you have other terms which are ESG, let's say purpose and impact. ESG is, of course, environmental, social, and governance, but it means that you want to do things right. I think that's almost what Tim also said. You are a good company if you do it. So you have to check for each investment, is there a risk on an environmental aspect, on a social aspect, and on a governance aspect? And of course, our responsibility as investors is if there is a red flag, not to invest. And if there is a yellow flag, let's say, to say how to mitigate it. Then if you have the purpose of doing something right, you want to measure it. And only if you measure what you want to do, then you are an impact fund. And Tim mentioned something which is very striking. He said, well, at the beginning, we didn't want to be impact. He had this very nice picture. And I remember discussions with Daria, for instance, and she told me, no, we are not impact. And that was a very interesting thing for me because I thought about this word. And especially in the German-speaking area, we seem to put impact next to philanthropy instead of next to earning money. And Tim also said, there is no trade-off between impact and financial return. And I think our community is working so much on this to show not only there is a possibility of a good performance with a positive impact, but what we want to do is we want to outperform actually because we solve the real problems. So that's why we are all investing so much energy in this business. And it's of course, it's tricky. I mean, the way the World Fund is doing it is to say, well, we have one criteria and we will measure impact towards this one. There are other ways of doing this. We do it in another way. Perhaps I will answer it later. But the very important thing is that we are always in mind what we have to do is, first of all, to be ESG compliant, not to harm and to develop a sustainable business model, and to find out what is materially relevant in the business model to push the impact. And if you do this, then you can be proud to be an impact investor.
Pushing the impact is kind of a challenge sometimes, isn't it, David? Adrian, I've seen that within teams, sometimes it seems a little bit like there is an internal fight going on, where sometimes the assumption is, well, maybe if we want to create impact, we cannot really create the financial returns. How do you do your job in terms of making sure that everybody understands that there is this lockstep?
It's not that easy to put at first. I mean, actually, if you are not an impact fund, as we are, that also gives you some flexibility, because when you look, we as a high-tech investor, we just look at the technology. And a World Fund, they also have to calculate, is the impact enough for us to invest? And actually, so if you set yourself up as a fund and you say like, well, we invest in good technology, then that's maybe helps you to even get those deals that in the beginning don't show this ex-ante perspective of getting good results on CO2, but in the end they do. So actually it gives you some flexibility, but of course within a team, and we because half the money we invest comes from KfW and also from the Bund, therefore it's tax money, and therefore we have some, I would say, reputation of being a bit more bureaucracy heavy. That's just because we have some more regulations on top of us. And therefore, the job of an ESG manager is not that easy, because it's you again tell your colleagues, okay, we now have to do an ESG due diligence. We now have to do an ESG reporting. And my job is exactly what you just said, Isabel, that we are creating value for you guys as a investment team in giving you the right direction towards those, climate tech and impact deals. Because we just did an analysis we presented last week on the Enkelfähig Summit at Haniel. And we, even though not having this kind of focus on impact and climate tech, we clustered our portfolio, and we have since 2005 we are investing, so quite some numbers there to analyze, and we saw an outperformance on our climate cluster. So that was nice to see, and that's also something that helps you, of course, then in discussions with your investor team.
Absolutely, congratulations, Stefan. I'm going to be a little bit unfair with you, and I'll ask you for a war story, because the war stories are usually what makes this really, really interesting. Has there been a case where, in the beginning of looking at an investment, the impact case looked so absolutely abundantly clear that nobody really questioned it, but by the time you went into due diligence, you realized there's a lot more to this than we thought?
Yeah, there's been a couple of cases actually over the 2 years that I've been with the fund. I think the most prominent one that we found is in plastics. So especially when you're talking about single-use plastics for food, we invested in Recup. It was one of the first investments that we did with the fund. And while we did this investment, it turns out that you can actually, also before I joined the fund, I thought, plastics, massive topic in terms of CO2. Obviously, you always hear about it in the news, that plastics is clogging up our oceans. It's the worst thing and the worst material in the world. But if you go into the calculations and you actually do the math, and there's been a study from the University of Freiburg that it's called the Freiburg Cup, if I remember right. They basically did a study around how often you have to reuse this cup before it becomes better than how often you have to reuse the cup before it becomes better than a single-use cup. And it's really, I thought it was about 120 times. So you have to use it, wash it, reuse it 120 times before you actually get better than using a single-use cup 120 times and throw it away. So that was pretty striking to me, and that also made us actually get out of that investment, because it turns out that if you don't go on a global scale with this concept, you could not reach the threshold that we need. So the threshold that Tim talked earlier about, it's about per year the equivalent of a forest the size of Germany that we're looking for in terms of sequestration. So just or 22 million cars as a comparison. So that was quite interesting to me, that specific case.
Maybe to dive a little bit into Recup, because I like this case a lot, and I think we have a couple of Recups here on location. Do we? Have you guys seen some Recups? Yes? Lovely. Under the premise that Recups becomes very successful, as they already are, and their type of plastic is more in circulation, and there is a certain point where we cannot really influence human behavior so much, is there a case to be made that it might also be a risk, Isabel, do you think, or not at all?
I think he should answer, because I'm not a specialist on Recup. That's the complexity is so big in such a business model. Just having a short view from outside is never enough. So you really have to deep dive into the business model, into the materials, into the logistics, into the production process. So that's why I really cannot answer this. I mean, we always go so deep, and sometimes we need a life cycle analysis, and only afterwards we can say, okay, it's something that it's worth looking at or not. But I would like to say something to Adrian. The striking thing about ESG, and I'm far away from impact now, I always ask me, why is this that, another word for venture capital is risk capital, yeah? So our job is to work with risk, and we have to analyze, of course, the opportunities, but also the risk. How can it be that we say we don't look at one part of the risks? We just ignore them. We don't want to see what happens on the environmental and the social and the governance side. It's of course something for the reputation, but only also a financial aspect. If you don't see something, in a business model, you might have a huge issue at some point. And we have to be very careful about it, because for us here, it seems very obvious. And I had a discussion with a huge family office, a German family office, and they work with the Florida pension fund. And they have put now in the side letter of their investments that they forbid their GPs to check ESG aspects. And that's really crazy. I mean, and that's something that, I always said, well, we have to check this. It makes so much sense. And then you hear something like this and you said, well, okay, we have still a lot to do. And that's why here it's easy to talk about this, but there are other places where it's not so normal. And that's why it's so important that we take really care of this, and that the first aspect before we talk about complex impact calculations is that ESG is absolutely normal and self-explaining for everyone. Then we can talk about impact and complex analysis of plastic or whatever. But please let us start with the easy ones. Yeah. Sorry about this, but
just to add, this as a personal story on Recap, we were going on the highway 2 months ago, and going to the restaurant there, and I said, I saw them having a Recap, and I ordered it, and the woman, she didn't know how to handle it and how to scan it, and she asked the colleague, and I was the first one since half a year to use that. I mean, all of us probably are moving in a bubble where recaps are usual. So, but it just shows that we have to do some work outside of our bubbles with topics like recaps, but of course also with topics like ESG management. And not having ESG, just to be clear, I think ESG and also ESG reporting is not adding any impact in the end when it's not done correctly, like filling out a template once a year and sending it to your investors. That's not going to save our planet. But nevertheless, it's something we have to do. Also looking at the regulation, and given that there are not going to be more cases like DVS last year with greenwashing, because all that regulation is about to make it more transparent to outsiders whether that investment might be green or is not green at all. It's just a kind of a EU standardization for outsiders. And I think for that, it is really important to have that ESG in place and an ESG reporting. And because we have it on here, also to put it in your term sheets with your ventures. We have huge debates internally, but also with our ventures. We say like, well, you're the only one guys asking for ESG reporting within your term sheets, and can't we get rid of that? And now at least we are at the point also in High Tech Gründerfonds to say we can't get rid of it. It has to be there. And I hope long-term wise they're going to be more on that, not only reporting, but also working on the topic of ESG and having that in a term sheet.
Yeah, I would like to add, because it's a type of the regulation. Actually, Adrian, I think in some times, at least in 1 or 2 years, since most funds are now Article 8 funds, and as far as I know, last year there was only one fund that is not at least Article 8 that has been created in Germany. So I think in let's say 1 or 2 years, most funds will ask for the same ESG aspects as you do, because it's the ones that are defined in the SFGR, which are CO2 footprint, biodiversity, water and waste, and then labor conditions.
UNPR.
Yeah. And then diversity and gender pay gap. So, and I think it's not a lot. So it's okay if you just ask this. The problem is many LPs or other people, I've thought the longer the list, the better. And they have created a nightmare of bureaucracy to put other things. And then, of course, it's not integrated in the business of the portfolio company. They give it to their CFO, who has no idea, who doesn't care. And then you get a list and they say, well, not available, not applicable, and it's no value add. And that's why probably the question is not having something in the term sheet forcing your portfolio company to have to report about anything. The more important thing to push sustainability within the portfolio companies is really to engage with them and to work with them on their business model and to help them developing a sense for sustainability and to really think about the sustainability challenges in their business model. And then it's not something that the CFO or the ESG manager is doing, but it's something that the top management is doing. And then it makes a lot of sense. And I was asked, I think last week we were at a dinner together, and I was asked by many people, well, who is the ESG manager at your fund? And I say, well, of course, I do something about ESG and impact, but every one of us is responsible for ESG and impact for his or her portfolio company. Because if they say, well, you know, the ESG topic, go to Isabel, she will take care, then they say, well, it is not really relevant. If he doesn't care, why should I care? So I don't mind. And that's the real problem. You have to integrate this ESG and impact into the strategy, and the term sheet is just a paper, you know?
Yep. I think that's exactly right. I think in terms of, as we said earlier, we at the World Fund believe that the financial performance is closely aligned with the climate performance, and the same for ESG. So if you have an investment manager that cares about financial performance or operational performance, and they don't care about ESG, it's a misalignment within kind of the investment structure. So for us, it's the same way as with you. We have each investment manager that does the investment also kind of goes over with the portfolio company once we have invested through the whole ESG checklist, and then reiterates that on a half-year basis with them together to see if they can check off one or two items every half year, and that will bring them closer and closer to when the potential exit, a potential IPO or acquisition happens, to be in a good place in terms of the ESG.
Absolutely. I'd actually, Stefan, because we were just, or Isabel, you were just talking about this. Stefan, how at the World Fund do you guys actually work together with your companies to make sure that there's not just an awareness of impact, but they're actually essentially integrated impact, not just before the investment, but going forward? Because as you said very right, and I totally agree with you, it is our responsibility as investors, as we own part of that company as well, right? So how do you guys do that?
Yeah, I mean, I think in terms of, as I said, we're very closely focused on the climate aspect. So that's the main focus for us at the moment. We'd like to do more on the other topics on ESG as well. But for now, in terms of the CPP, there's a do no significant harm section in there that basically says, okay, we've gone through all of these potential risks. If there is a risk, a yellow flag, we know how to mitigate it. Otherwise, if it's a green flag, we're fine with it. But really, we need to get to the CO2 threshold that we require. And how we work with companies there is we set it up like a financial KPI. We say to them, okay, every quarter you're going to report to us. For example, for Juicy Marbles, it was a plant-based steak producer. You're going to report to us how much input you had in terms of your feedstock for your production. You're going to report how much product you have produced, and from that you can calculate how much beef you have potentially replaced, and you can calculate your CO2 impact directly. So they report that to us as a financial KPI every quarter, and then there's also a milestone plan. So as you would have with a financial model, you have targets that you need to hit, and if they stray from that path, if they're doing really well or exceeding the milestone, then we're good with it. If they stray from that path, obviously the investment manager works with them to see why that's happening and if the targets need to be adjusted or if there's something else that we can help them with.
I'm going to ask a really unfair question to all of you. Given that we have put all of this in place pre-investment and it's all there, how do we make sure that we do not bury our founders into the burden of having to report on countless and countless of positions that, even when they are very early stage, might not even be there after half a year? How do we make sure that this doesn't become, how should I say, not just uncomfortable, but as a matter of fact, something that makes us less competitive as investors when compared to others who might not require Article 8 or Article 9 reporting? To all of you, whoever wants to go.
Maybe I give it a start and you guys continue. Well, I think at one point, given also the statistics that no Article 6 funds are set up anymore, in the long run, everyone is going to have an ESG reporting in one way or the other. The question is just, do we want to see, like in the next funding round of a startup, 4 new investors come on board, 4 different ESG frameworks with like lists of 100 of questions, and how do we deal with that? Or do we try to tackle it now early on, where everyone is kind of trying to set up the questionnaire and building all those frameworks? And that's what we are trying, because we see that danger, and we are in the pre-seed and seed phase. Therefore, the capacity of the ventures, it's always limited, nevertheless, the stage, but the teams are really small. And when you expect them to fill out ESG reporting, it's not only your own, but also the ones from other funds. At one point, they're going to say, like, damn, this ESG, we're not going to do that anymore. And of course, like doing your normal report, you can also say, yeah, well, I stopped doing the ESG reporting as a venture. You could. So there are some initiatives. And there are also larger investors like KfW Capital. They are invested in many funds. They have standardized framework and questionnaires already, which are used by many VCs out there. And we are also in exchange with many like traditional VCs, also some impact VCs on how to get a standardized questionnaire. I think in the end, it comes down to roughly, let's put like 40 to 50 KPIs. And then you can, if you calculate them and know them beforehand, then you can always put them in the questionnaire. So it's like, and please feel free to reach out to me, for example. I can share like the KfW questionnaire with you. And we hope together with some other players in the ecosystem to make kind of a standardization there. That, as an example, like they also make the differentiation that when you have less than 15 employees, there's really just a really short ESG questionnaire. And then when you have more than 15, then you're also maybe capable to fill out like a 40-question questionnaire on ESG once a year. So it's really about collaborating, because and I think I told them 1 or 2 people in the crowd already in a bilateral meeting. The end boss is the kind of the taxonomy or SFDR or whoever you want to call it, and we are all kind of playing against that one. It's not about normally in venture capital. Of course, you always you do deals together with other funds, but still you look on your own portfolio. And when it comes to reporting and ESG, you're working together, and you can, and at least I have the impression that everyone is open to share what they have been doing. And if you're just in a process of getting started, reach out to the people, because some work has now been done in the last 1 or 2 years, and you can kind of start building on that.
Yeah, just really quickly, I think in terms of what you said with overburdening the founders upfront, it is work to put in, but I would actually say that if you procrastinate on it and you just keep it until, okay, I'm now in a Series B and now my investors are asking for it, you have to catch up on all of that. Whereas we take the approach, okay, we start with it early. We try not to put too much on the founders at once, but we at least want to have kind of a check or a benchmark where they're at now. And then we work with them, like I said, every half year or even just every year if it's very early. One goal every period, and that prepares them for that. So I think it's actually easier to do a little bit every over a time period versus just doing everything once you need it.
What I have not mentioned before is, before I was now at the Green European Tech Fund, I have set up Coparion as a state-owned fund with the EIB as an LP, and we were one of the very first fund having an ESG due diligence. So at the time I was there, I was responsible for 80 ESG due diligence. And at the very beginning, and one of my colleagues is here in the public, and everyone told me, well, you are crazy, we will lose the deals because of you, because you have then put us an ESG due diligence and we don't want it. So that is now 8 years ago. And thanks God, things have changed, and now it's more normal. So I'm very happy that these things happened. But still, in some competitive cases, it might be that in the term sheets or in the clause, some funds can play on this and try to do less. For the time being, they have the possibility, because some law firms have said you don't need to check the principal adverse impacts. If all funds would check the principal adverse impacts, we would get rid of this discussion, because they would all then use the same framework. I'm not a fan of the 50 questions. I don't think it is reasonable for startups. I think we should really concentrate on the most material aspects. And for us, but we are in a bit of a bubble with the type of startups that we finance, I think they don't see us as a burden. They really see us as someone who brings a value add, because we help them to structure the way they approach impact. And what we have seen, or especially my colleagues in the former portfolio, is that having done this job with the management of the portfolio companies, they had for each further funding round or for exits, all the discussion on ESG and impact was already done. So it was a check, and that was a really value add in the transactions. So we could show that it is not only nice to have, but really essential for the value of the company in such a transaction.
But the danger for impact funds, the danger isn't that great that you guys lose the deal, because the ventures are open to ESG, and to the whole concept of...
Can you repeat?
The danger of losing a deal because you're telling them, well, we have to put ESG and impact measurements in our term sheet is rather limited, or is it?
Yes, because we have a bias, of course, because we deal with founders that really are interested in the topics, and most of the time they don't see how to manage really it, how to put it in their pitch deck, what is their impact. Most of the time it's a purpose and not the impact, because they don't know how to measure the purpose they want to show. And that's why we can put value add. Yes, we have decided to be in a much easier bubble than yours, but your job is very important to spread it all over the place. So I need to work together. And you know that I really fight for having everyone working on the principal adverse impacts, because it's necessary to have this common sense or the common understanding of what are really material aspects for our business. And just putting 100 questions is crazy. I mean, there are not 100 topics that are relevant to a startup. I'm sorry about it, but I don't know them, and I can't find them. And that's a pity, actually, that it goes in this direction, instead of really thinking what makes the difference in our business model. Then you really have a value add.
Three different aspects, three different ways of approaching this whole thing. And there is one thing that strikes with me, is that it seems like we all as investors can very much still be in power and let us steer this in a direction where it doesn't become a burden. Steer this in a direction where it doesn't look like a competitive disadvantage, or steer this in a direction where essentially it is a necessity to do the things that we realize that they are a necessity because of what I said in the opening speech, the things that essentially will also make other people act.